Greetings and welcome to this case study. Today we are going to do a case study on AUDNZD, that's Australian dollar versus New Zealand dollar. So as you can see on the chart, we're on the 4 hours time frame. So we are approaching the weekly supply zone. So for the 4 hours time frame, we are having several break of structure and several demand mitigation starting from here. Broke structure somewhere around here, indicated the demand. Broke another structure here a little bit, mitigated the demand. Broke another structure here, market mitigated this demand. So our entry now is this after this mitigation and change of character. So the entry is from the 3 minutes time frame. So we'll go down to the lower time frame to see what the chart actually looks like. This is the 1 hour time frame. So after that mitigation, like I showed earlier, had a change of character. So after the change of character, on the lower time frame, we had another change of character for this month. And this is what the 1 hour looks like. Break of structure, break, 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 then dip of liquidity, change of character, then demand mitigation. Now let's go over to another lower time frame, see what the chart actually looks like. So this is the 15 minutes time frame. So if you zoom into the chart, see that the price action is very, very clean. After we broke this low, it came down. And market also swept this low with a candle closure. They had a change of character, mitigated this inside buy supply zone before moving. So for this refinement here, it's on the 5 minutes. This other refinement here on the 3 minutes. So let's look at this chart here first. We're going down to the 5 minutes time frame. So this is what happened here for the move on the 15 minutes. This is the what we can see on the 15 minutes. Let's go to the lower time frame. So this is the 5 minutes chart. If you zoom into the chart, you see how the markets move. So after as this break of liquidity, market change character, mitigated this defined supply zone, demand zone. It also went further to mitigate the defined 3 minutes, which is that's when we say looking for confirmation to know whether we have entered a trade. So this is what the chart looks like on the 5 minutes time frame. We have a mitigation of the middle time frame demand here. Another then the market mitigated this 3 minutes demand. It was from this point started looking for. Let's go to another lower time frame to see the chart clearly. Now this is the 3 minutes chart. This is the 3 minutes time frame. So it was from this point to enter the trade. Now let's zoom in to see what's happened. So after market mitigated this 5 minutes demand, mitigated this 3 minutes refinement, market started having an impulsive move to the upside. So after this mitigation, we had a little change of character here. That's like an internal choke. That's what we actually had here. But that you can use that as a confidence that market is about to reverse. That's what we had here. And we had a little bit of imbalance, a very small imbalance. So market struggled to take out this swing high from here. Market struggled to take it out. Then later on, after a while, it took it out. At this point, the candle closure, the market came down to mitigate this demand zone. So market used these areas here as inducement to mitigate this candle. And if you look clearly, one of the notable things here is that the demand that the market mitigated is a single candle. So on several charts, you might also find this same thing. After a mitigation, you might see a change of character. When we see a change of character and we notice our point of interest is of this form, it can serve as a confluence that the point of interest will actually hold. This is a clearer view of it. This is a clearer view of it. Very clean change of character. Flip of liquidity, break of um, swing high, then formation of inducement, sweep of liquidity, then mitigation of point of interest. So after market mitigated that point, we rallied up to the higher time frame swing high. So that gave us a total trade of 1:32. That's a very nice trade. So taking profit at a high time frame swing point is very good because that's an area where liquidity is sitting in the market. So if you reached 1% of your account, what you'll be getting back on this trade is 32%, and that's a very good one. This is not a financial advice, but if you have a proper risk management scheme, risking 1% of your account on each trade, you'll be getting a very high return at the end of each quarter or at the end of each month. So that's it for this case study. See you in the next one.